things you should know. It can take 3 to 5 years to plan and implement a successful exit. And when I say that, you're not going to feel like you're out of your business or that you've exited your business till you get paid all the money. And SBA, you know, a lot of the buyers on the small end, they don't have a lot of cash. They go to the SBA if they're lucky enough to get 50 or 75. If they go to a bank, gets an SBA guarantee, and they're lucky to get 50 to 75% of your price, you may have to carry back. They'll allow you to carry back up to 25% or more, I think, of the sale of this. I know 25. I don't know about more, but they'll allow you as a seller to carry back 25%. But you can't get paid on that note for 2 years, and and then after 2 years, you can start getting paid on that note. So when I say that you're not going to feel like you left your business till you get paid because you're still going to feel the risk, you're not going to, you know, it can take time to get the financing part done. It's not really usually fully financed on the spot. Most cases, if you get 75% of your sale price of your business when you sell in cash, you did well, I think. Especially this economy right now. I got one, we're trying to help a guy sell his business. It would have been worth $500,000, you know, 2 years ago. Now cash flows are really down. He's got an interested buyer. Cash flows don't support the value. If I'm going to give an SBA valuation, it's not going to be very good. But the buyer's still really interested. And I don't know what uninformed buyer. I don't know if it's really uninformed buyer. They really think that the cash flows are going to turn around again fairly shortly. So what we're trying to do is just structure a seller finance contract that's tied to profitability of the business, so that the owner can go ahead and, you know, the owner's got a health issue and they really want to move on. So if that's the only way it gets sold, that's the way it's got to happen. But it can take 3 to 5 years to plan and implement a successful exit. This part right here, I think if you take one thing out of this class, this is a very good point. You can pick your date or you can pick your value, but you probably won't get both. So at the beginning, all these guys that run these exit planning organizations, the very first thing you need to do is identify owner objectives. How much do you want? How much money do you need? Who do you want to sell to? And when do you want to leave? You don't get to pick, though, in most cases. The only time you get to pick those 3 things is when you're independently wealthy of your business. Then you can do whatever you want. You can leave whenever you want, all that stuff. But for the most part, you're going to get to pick your value or pick your date. And I got a great example coming up here. But you're probably not going to get both. We've started to help our business owners to put in buy-sell agreements that are triggered by a value, meaning that right now my business is worth $500,000. I need $1 million out of it. I got an employee that's interested in buying it. So instead of saying you can buy it in 5 years, you can buy it when the value gets to $1 million. So you pick your value, not your date. The trends in valuation, like the stock market, your business is a very small cap, high risk, volatile stock. So values change quickly. Like you pointed out earlier, the architects, they're going to have to hunker down and wait it out if they want the value. The guy, was that architect? Yeah, it was architect. The guy comes to me and he gets a valuation, and he wants a valuation. And like I said, 2 years ago, I would have given it about a $500,000 value. He wants to sell it for to one of his employees for $300,000. The valuation comes out $100,000 asset value. Okay, there's not going to be any financing from the bank for that. And so, but he tells me he wants to retire at the end of next year. And I'm like, well, how do you feel about sticking around a few years? Because you can pick your value or you can pick your date, but you can't pick both. If you sell before your business rebounds, I don't know how you're going to get that money. I don't know how you're going to get the $300,000 unless till your profitability comes back up to about $75,000 or so. All you really got here is about a $100,000 value that you can get. Unless your buyer's got a pile of cash that came from, you know, somewhere else, the seller contract will fall apart unless the terms are really favorable, because the cash flow is not there to support a $300 debt service. So, you know, what I'm telling him is, if you really want to leave at the end of next year, you're going to get a low value. We've started structuring deals around when the value appears, you know, so when the value hits. So the next, let me see if I've got this next, or it's coming up. Anyway, the historical tax return, trends in valuation. So if your historical tax returns look like this, a nice even upward, you know, increase in profitability, and your 5-year projection is like that, that's the financial projection that everybody likes. Everybody believes it. Everybody's comfortable with it. Nobody sees any red flags. It looks great. Everybody loves that. This deal gets done. You know, now a guy comes along and he's got this trend in his valuation, and he tells me that no one wants to believe, you know, if we're trying to get banking for a deal that says, okay, the architectural firm's done this for the last 2 years, but we're going to do this the next 3 years, so give us the money. Nobody's going to bank that. Nobody's going to touch it. You know, that's the only way this valuation that I could come out with an income value that's high enough to support what he wants is to go along with projections that say everything's going to get way better real fast. And, you know, we don't think that. The historical tax return trend going down. This is a real killer right here. Everybody, buyers, the bankers, everybody confident, the fear. I mean, I see this when guys come in and they want to buy a business. If they see 2 or 3 years where profits are going up, it's like, it's all green light, man, they're in. But 2 or 3 years going down, I don't know. It's really scary. I mean, you know, so if you're trying to sell your business on a downtick, it's a lot harder because it's the same thing as investing. I mean, when the market's going up, everybody wants to buy. When the market's going down, everybody's scared and they want out. And you know, when you're trying to sell your business and it's coming down and it's on the down, people don't want to buy it. When it's coming on the up, people are in. Range of values. Car's value, just like a car's value, depends on the buyer. You could sell it to a family member. You could sell it to a car dealer. Sell it to a private sale. You know, a car dealer's retail price. You can see that the same car can have multiple values. Business is no different. Liquidation value, go public value. Sale to family. These are actually in order of how we see most of the time the value being. Sale, third-party broker sale, sale to employee, management buyout, ESOP, controlled auction process, synergistic buyer, and going public. Pick your value, pick your date. Already went over that. Here's a guy, we were talking about you can pick your value, you can pick your date. The guy, this is a profile when he came to us. I think this was 2007. And he said, well, he wanted to sell his business. We valued it. It was worth $4.3 million. His real estate was worth $700,000. His stocks were $1 million, and his bonds were $500,000. And he was 56 years old, 20 years in business. Most of that 20 years, he'd earned $100,000 to $200,000 a year. But in 2008, he's in a construction-related business, and he made $1.1 million in his business. He lives on $120,000 a year. But he was smart enough to know, well, okay, so I kind of would like to leave my business, and if I can get $4.3 million out of it, I want out. And so when the value came up to $4.3 million, he sold. His assets at that point for risk-taking were $5.3 million. So he was 82% of his wealth in risk-taking. And my advice is that if yours looks like that, you need to focus on picking your value and not your date. Because if you try to focus on the date, you may wind up losing all the value. If you've been and you've developed a substantial portion of your assets outside your business, you're not dependent on the proceeds to be financially independent, then you can focus on what date you want to leave. You have complete control over that because you don't need the money from the business. And so this is what he looked like after he sold, which was in 2008, and it's lucky he did because I think that company's worth about 1/3 of what it was now. And they're struggling to make it. They're struggling, the company is now struggling just to stay alive because of the debt service involved. Originally $3 million was financed, and I think actually the outstanding balance is half that, and they've refinanced it and done a bunch of things to make the cash flows work. But they managed, the new owners managed to make enough money quickly after the sale to paid down a lot of the debt, so that when profits really declined, they didn't go belly up. This guy, you know, he ended up with stocks of $1 million, bonds of $3.4 million, and real estate of $1.5 million when it was all over. And so he went from a scenario where he was 82% invested in risk taking to a scenario where he's 82% invested in financial security. He sold his business in 2008, put the money in the market. We didn't put it in stocks. We didn't have any need to take that risk. You know, I would have felt terrible if I was the investment advisor and put this guy's business proceeds in stocks, because that would have been a hard ride, you know, for what the market did. But we didn't have a need to do that. What's the point of taking the risk when we can service his lifestyle out of the bonds. The only amounts that we put in the stock market were the amounts that couldn't be serviced out of the bond, was the amount in excess of what it took to service his lifestyle. He gets like 150 grand a year off of the bonds, and a little bit off of the real estate's a little part of that. This was a construction-related company. The guy was 65 years old, 30 years in business, 800,000 a year in net income. Business was profitable. Owners did everything right. The buyers had good management skills to take over. They were doing an inside sale. But turns out the buyers had no money to purchase the business. When he went to sell it to them, found out they had bad credit. They were a good management team, ran his company real well. He didn't have to be around a lot, but they didn't have any credit. So the transaction ended up getting canceled. Nobody would touch it. And this was actually before everything, I think this was back in 2008 also. And there was a construction-related business. Didn't happen to be one that got hit too hard because I think it's road construction related. But the business value at 3.6, I think, is pretty much still there. It's just that it's going to take him a little bit longer. His assets for risk-taking, 58%, for financial security, 42%. I think they're going to turn around and sell this business in a couple of years. But let's see. Exit planning tips. You can pick your date, you can pick your value. You're probably not going to get both. Focus on net proceeds. A lot of things you can do in the sale of a business to structure the deal where you actually end up with a smaller sales price. You can wind up with more take-home pay. The only thing that matters is the money that is what you need to get. If you focus on what you need to get and then look at the different ways that you can sell it, focus on the net proceeds. Between compensation planning and tax strategies, there's a lot of things you can do in the deal. Inside buyers need good credit. Main Street is different. The sales process, the value drivers, the buyers, all that stuff we've seen in here. Main Street's different than middle market. Be careful about stuff you read. It's hard to decipher what applies to your business and what doesn't, and what really means something. I guarantee there's probably 3 to 5 things that really mean something for your business that have most of the impact. If you don't want to leave, focus on financial security. I have people tell me all the time, I say, well, when do you, so answer me 3 questions. Who do you want to sell to? How much money do you need? And when do you want to leave? Well, I never want to leave. I want to die at my desk. And they say that all the time. I'm like, well, how am I supposed to write an exit plan for you then? Okay, so here's your exit plan. Develop financial security independent of your business. That way you can stay until you die at your desk and it won't matter. That's the best exit plan I can think of.